All right, welcome here to, this is in our 6th week. We just had our first exam. We're looking now at chapter 19, and we're going to be talking about cost, volume, profit. And what that means, or basically we're going to be looking at, is do costs change because the activity level has changed? Activity level meaning if we need more, product, if we need more time to make the product, will that increase our costs? And so I have a couple examples here, one where yes and the other one is no. If we were to take an airline trip, and you would easily know this if you just looked up a couple flights. If you look up a flight to somewhere in Europe versus a flight to somewhere in Florida, the Europe flight is going to cost quite a bit more because it takes longer time. You've got to pay the pilots more, and there's a lot more fuel that's needed. Whereas where a trip to Florida can easily be done in just one trip in probably about 2 to 2.5 hours. But in a case where volume doesn't necessarily mean there's a change would be an example of an emergency room. Usually you're going to have a set number of nurses and doctors and then other aides to help out on any given weeknight. And then they're going to be staffed like that, ready to go, regardless if they have 10 patients or 50 patients. So that's more of what's considered a fixed cost. And this one up here was more variable, where the more supplies you have or the more time is needed, the cost goes up. Usually it's on a pretty equal basis. So that's what we're going to mainly look at today. Is one of the main things is fixed versus variable cost. All right, so I gave us just a little more background here on the variable cost. Your total cost, if it's a variable cost, your total cost will change with the more items or more sales that you have. So you produce more, you're going to have more of a total cost. So think of it like the airplane. You need more gas. The farther you fly, the more gas you need. However, the per unit cost won't change. It's still going to be X number of dollars, say $5 a gallon for an airplane trip. No matter if you use 10 gallons or 100 gallons, it's still going to be $5 a gallon. It's just the total cost will be different, whether you use 10 or 100. And so that's what my little example here is to show. If we were in the business of making golf clubs, and a golf club the iron that goes into the golf club is $1 a pound. If I expect to make one golf club, that's going to cost me $1 in direct materials. And then so you can easily see, if I expect to make 10 golf clubs, that would be $10 in materials. So the total cost went up, but the price per item, price per iron didn't change. That's considered a variable cost. And then this is kind of a nice little graph for visual purposes to help see that. The more items you sell, so we sold 1,000 golf clubs, so it's $1,000. 2,000 golf clubs, $2,000. Whereas no matter if I sold 1,000 golf clubs or 2,000 golf clubs, it was still $1 a piece. No change in the cost per item. Well, now where that's exactly flipped is with the fixed cost. Fixed cost, now the first thing you got to know when you talk about fixed costs is we're talking within a relevant range. You can't be so wide of a range that it doesn't make sense, and I'll talk about that in a minute. But as long as we're within a relevant range, the total cost will stay the same. It's the per unit cost where I divvy those costs out that will continue to go down the more items I make. So I can spread out those costs more for the more items that I make. So if we were looking at a school setting, the total overhead cost, now let me go back, the variable costs are generally deal with your direct materials and your direct labor. Whereas fixed costs typically just deal with your factory overhead costs. So these factory overhead items, no matter if I have 500 or 1,000 students, I'm still going to have depreciation on my building. Still going to have the same insurance, same property taxes, and I'm still going to have a school team. all of those costs, it doesn't matter if I have 500 or 1,000 students, those costs are going to be exactly the same. And that's what I have in this, my little example here. If I have to pay a dean $40,000, I'm going to have to pay that dean whether I have 2,000 students or 3,000 students. But where the costs differ, as with the variable cost, the cost per student actually starts to go down with the more students I have. So I'm spreading out 40,000 over 2,000 students. But if I have 3,000 students, now I'm spreading out that 4,000 over more students. So therefore, the cost per student goes down, which is what you want. You want to try to maximize and get the most benefit out of your fixed costs. It's much easier to deal with $13 per student than $20 per student. Now, the relevant range, and we'll look at that coming up, it wouldn't be 40,000 for one dean if I had 20,000 students. That's not within a relevant range. There's a big difference between 2,000 students and 20,000. So you're going to have to, as a manager, you're going to have to find that range where one person can easily handle between 0 and maybe 4,000 students or 3,500 students. So the same with the variable cost. Look how our graphs are just flipped with the fixed. With the fixed cost, whether I have, say, 1,000 students, it's going to cost me $40,000. If I have 2,000, $40,000. 3,000, $40,000. But whereas if I have 1,000 students, that cost is $20 per student. If I have 2,000 students, it's $13. If I have 3,500 students, maybe it's down to almost $10 per student. So the cost per item goes down, which is what you want as a management. All right, so here's my little relevant range topic. If you do increase to, say, 10,000 students or whatever it is, 20,000, then your fixed cost will go up. You're going to need a new dean. Maybe you need a new building or at least an extension onto a building. So therefore, your property taxes go up. Your depreciation on the building goes up. So a lot of your fixed costs, instead of it being a straight maybe 100,000 total, now it's more like 220,000 or something along that line. So here's a little graph of the fixed costs. So if I had 100 to 450, say, students, it's going to cost me $2,000. 450 to 800, it's going to cost me $4,000. And each time I hit that next mark, my fixed costs do go up. So it would be good if I could be right around in this area or right around in this area for fixed costs and total output. I don't want to be right over here because I'm not getting very much return on the actual dollar amounts, whereas way over here I'm getting a lot more. And then the last thing to look at with variable cost is they don't always go in a nice, neat line like this. There could be times where it's going to cost you a lot more up front to buy something because you can't buy it in bulk, or you can't buy it and get a real cheap shipping rate, where if you buy a whole bunch, you get a lot cheaper shipping rate. So per item, it's going to cost you a lot more. But then once you get into this maybe like sweet zone here, then you get a little bit of a discount. You get the bulk shipping. But then where it starts to possibly go up again is when you have to pay your people overtime. You have to pay some excess fees, whatever it might be, to ship, because it was, instead of the limit of 50 pounds, it was 55 pounds, so your cost goes up. So variable costs typically are in a straight line, very, very even, but at the beginnings and the ends of those, they could be a little bit different. And then our last item with the fixed and variable cost is, well, a lot of things have both in the one item. And this would be an example, say, if you were on a phone plan with data usage. With data usage, you may get X number of gigabytes for $20. But then every gigabyte that you go over that number, whatever the X number of gigabytes your plan has, for every gigabyte, it's going to cost you another $15. So if you just have, let's say, a 20 gigabyte plan, and you only use 19 gigabytes, that's your basic fixed cost. But if you have 21 gigabytes, that's going to cost you your fixed cost plus the extra additional variable costs depending on how much over that 20 gigabyte plan you used. So that would be considered a mixed cost. It has definitely your bare bones fixed cost and then your variable cost by how much over the fixed are you. So I give a little example here, and you can now pull this up. This is the first one that I have in your lecture examples. If you go into the resources in Blackboard, or you can just use the screen here. But if you wanted a hard copy, I do have that. And once I get done looking at this, it's helpful for you, I believe, if you pause the video, try to figure out your answers, and then come back and I kind of hopefully will help explain it to you in case you missed it or to verify if you got it right. Okay, so we have an airline, and this is kind of an example of a mixed cost because to even get that airplane off the ground, we're going to have a pilot. We're going to have some fuel. We're going to have depreciation on the plane. So there's some basic costs that are going to be there regardless. And those will be our fixed costs. But on this one, I'm just going to look at fuel. And I'm going to say, for this airplane, for it to get from Indianapolis to Orlando, it needs 200 gallons of gas. And that gas is $4 a gallon. Now, that plane is going to need 200 gallons regardless if we have one or all the way up to 150 people on board. Now, for every extra person after 150, we need 1 gallon per person. So if we have 160 people, I need 10 extra gallons. I'll need 210. So what I want to know is what's the total cost for 340 passengers? And then broken down, how much does it cost per person to fly 340 people? And then do the same for 120 passengers. So go ahead and pause the video, work this out, see how you do, and then we'll go through the answers. All right, so if I had 340 passengers, I know that my fixed costs were $800. I'm going to have 200 gallons at $4 a piece, even if I don't fly anybody, just the one person. So that's $800. That's going to be there regardless. The variable costs say I have 190 people over that first threshold of 150. Remember, I can seat up to 150 without any extra gas. Well, I have 340. That's an extra 190 people at $4 a gallon, because remember, each person requires 1 more gallon. So 190 gallons at $4 a gallon is $760. So my total cost would be my variable cost, or my fixed cost at $800, plus my variable at $760. So my cost per person, so this was one answer, total cost. My cost per person, well, I just take my total cost and divide it by how many people do I spread that out over. So that was $4.59. Now I do the same thing for Part B. 120 passengers. I am going to have my basic fixed cost of $800. But variable, I don't have anything. I haven't even reached the $150 threshold. So all 120 passengers are going to have to cover this $800 fee. So 820 over 120 passengers, my cost per gallon went quite a bit up. My cost per gallon, instead of it being $4.59, because I'm spreading that original cost out over quite a bit, now $6.67. So that's quite a bit higher per gallon that I need to spread out by people. So it would be best if I had at least 150. At least 150. All right, so now you may look at some data, and you've been given the total cost, and you've also been given the total units sold, or whatever you're looking at. You can, with that information, if you're given multiple different sets, so you're given January's numbers and March's numbers, all the way through the end of the year, if you're given that kind of information, you can determine with that approximately, it's not exact, but you can determine approximately what your variable costs and fixed costs are without being told what they are. All you've got to have is total cost and items actually sold or whatever you're comparing. So what you have to do is in each of the columns, you have to find the least amount and the most amount, and then take the difference, and then simply divide. So and that's going to give us our variable cost per unit. So we're going to find the difference. So this is what I have in my little example to help us explain this. I have number of students and the cost to run the school. Because just by running a school, you don't have just fixed costs, of course. For every 20 students, you've got to add a faculty member, or whatever it is. And then you're going to have to add probably more electricity if you have more students. There's more usage of that. So there's different variable costs that go along with running a school. So here I've had 900 students the first semester, and it costs $500,000. And 950 in the third semester, $522,000. I bumped it way up to 1,200 students for a total of $605,000 in that fourth semester. Now, to get the variable cost, that's the first thing I have to work at. Just with this information, I can easily get my variable cost just by doing this little formula here. Figure out what's the difference between the least and the most on each column, and then simply divide them. So I had 300 student difference and $105,000 difference between my two most and least columns. So my variable cost per unit, for every new student that comes, it's going to cost me about $350. Now, we can easily find the fixed cost now that we know the variable cost. The little formula here is to show us how to get total fixed cost. Take our total cost minus the 350 variable times how many units did I use. And you're going to see that it comes out the same no matter which semester I look at. So if I look at the fourth semester, $605,000 in cost, minus what I just figured, it cost $350 per student, and I had 1,200 students. If you do the math here, it comes out to be $185,000. That would be my fixed cost. I do the same work here for semester one. The total cost minus what it costs per student times the number of students, and it's $185,000, just to show that it works no matter which method, no matter which semester we use there. Our fixed cost is $185,000. So I easily was able to determine then my variable and fixed cost. Now our next new terms that you need to know is the terminology here of contribution margin. Contribution margin is what you use in managerial, very similar, somewhat similar to what you use in financial, where we use gross profit. So gross profit, just to kind of refresh your memory with financial, back in Accounting 101, remember it was sales minus what it cost you to sell your stuff. That gave you your gross profit. And then you subtract out all your other expenses to get net income. Well, with managerial, you're sometimes more concerned with knowing your variable costs and your fixed costs. So you take your sales minus your variable cost, and that gives you your contribution margin. So it's sales minus contribution, sales minus variable cost. And then if you take your contribution margin, what you just figured, and subtract out your fixed cost, there's your net income again. So it's just a little bit different from financial, but somewhat similar. And what this contribution margin is telling you is, and the reason it's important, if I sell one more thing, just one more item, how much will my profit go up? If it's $1, it may be worth it, as I say here. Or if it's only 5 cents, well, is it really worth to put the extra work into it and to sell one more thing? For that contribution margin, if I sell just one more, how much will my profit go up? Knowing my fixed costs are going to stay the same. The back half of that formula. And then we come to the contribution margin ratio, which is for every sales dollar that I bring in, how much income will come from that. So if I bring in $1, will I bring in 20 cents in income or 70 cents? That's what this contribution margin ratio is there to tell us. So the formula here, these are both the same. Sales minus variable cost is the same thing as contribution margin. So sales minus contribution cost divided by our overall sales. And so I took this from our previous example here in semester 4. And the tuition for each student was $1,500. Let's say everybody took the same number of classes. And I want to find the contribution margin and the ratio for that semester 4. Okay, so remember, we just take sales minus our contribution margin. Or sales minus our variable cost. Remember, we already know what our variable cost is per student. We figured that out in the previous example. It was $350. So here's my overall answer for this one. The revenue, well, it's $1.8 million if I have $1,500 coming in per student. And remember, there were 1,200 students. So 1,200 students at $1,500 a piece, $1.8 million. Variable costs, only $350 a student times the 1,200 students. So my contribution margin is $1.38 million, which is good. $1.38 million over the $1.8 million in sales means for every new student, 76% of their money that comes in goes to my profit, which is nice. So my second little example here. So if we add another 50 students, 50 times 1,500 is 75,000. Net income would go up 57,500. That's how I can use that contribution margin ratio. That's where it's, instead of redoing the whole problem again. This contribution margin ratio says, as long as you give me the amount of sales, or in this case sales dollars, if you give me the amount of sales and I multiply it by this ratio number, I can tell you what amount of that sales coming in will go to my profit. Okay, this one's kind of self-explanatory. Unit contribution margins. Just take the $1,500 per person minus the $350 variable cost, and $1,150 is our variable contribution margin for the unit. All right, next we come to the break-even point. Break-even point would be how many students, in my last example, how many students do I need where I don't make any profit, but I'm not losing money either? At some point, if I just have 3 students come to my school, I'm going to lose money. Even if I make, so much per student, I have way more fixed costs, and I'm not even come close to covering that. So how many students do I need, bare minimum, just to break even? And of course, you don't want to just break even in a business. But if I have to break even for a couple of years, what do I need to be at? So I want to basically is, how much revenue do I need to cover both of my types of costs, variable and fixed? And the easy way to get break even in units, so we're going to do 2 ways of break even. The first one here is break even in units. How many actual students do I need to cover my costs? So simply just take your fixed costs and divide it by your unit contribution margin, which we just did on the last problem here. Unit contribution margin for every student, I'm going to make $1,150. And then if you want to do it the longer way, the mathematical formula, you can do that. And I'm going to show you both ways. So how many students are needed to break even? All right, let's if you want to pause, go ahead and pause for a second and try to do this little formula based on what we just did. Use this formula based on the information we just used. Okay, so our fixed cost, let's go back up. We determined that in a few sections ago. We figured up our fixed cost was $185,000. If I take $185,000 and then divide it by my unit contribution margin, $1,150 per student, If I divide those two, I need 161 students to break even. But that's okay. 161 students to break even. And I did it the math way here for any of you that wanted to see that. Now I can also prove that, which I like to be able to see, just by throwing out 161. How do I know that's really accurate? Well, let's see. Sales minus variable cost minus fixed cost better give us a profit of pretty much nothing. So sales, if I have 161 students at $1,500, I'm bringing in $241,500 in sales. Subtract my variable cost for those same 161 students at $350 apiece. When you subtract out these two, you have a contribution margin of approximately $185,000 minus my fixed costs of $185,000. Therefore, I have profit of nearly zero. Now, the other way to get break even is to do break even in sales dollars. So before I said, how many students do I need to break even? This way says, how much money do I actually need to bring in to break even? And the easiest way to do this is you just change your denominator here. Instead of using contribution margin per unit, we use our contribution margin ratio. So fixed cost divided by our contribution margin ratio. I need to sell approximately $241,300 worth to break even, and that number matches within rounding my sales that I did on my previous proof. Okay, just a couple more small things, and then I'm going to switch videos and do the Wiley Plus example that I wanted to go through. I don't believe this week's Wiley Plus is all that difficult. I think this material is kind of, it makes sense. You probably have seen this in some way or another, or at least have thought about it. And so that's why I think it makes more common sense. This target profit, what that is basically telling me how much do I need to sell to get where I want to be. Break even is okay, but I don't want to be at just break even. I want to make money. And so what this is saying is, let's not stop just at break even. Let's figure out how much do we need to sell in order to get to the profit we want. And so we're going to do the exact same formula we just did with break even, except one little piece added, and that's the amount of profit. So I'm going to take my fixed cost, which I already did, and just add in how much profit I want to make, and then simply divide that by our contribution margin. So go ahead and try to do that with this one, knowing I want to make $500,000 in profit with this school. How many students am I going to need to make $500,000 profit? Well, if we take our 650, this is kind of a repeat, I can get rid of this first little part. Fixed cost, and then I already know what my unit cost is, and now I just need to add in that profit. So 685,000 divided by what it costs me per person. I need 596 students to have a profit of 500,000. Whereas if you remember earlier, the break-even point was about 161 students, I believe. And I can prove this, just like how I did with the break-even. And you can go through and look at that for the proof. Now, I wanted to put everything together that we just did into a graph. This isn't a graph of exactly what we just did. This is just a generic graph. Where I have the break-even point, this would be our profit range. This would be our loss range. And then they go ahead and tell us the rest of this. So if remember, this is my total cost line right here. And if I sold here, that's how much profit I'm making. Same with the loss. This is my sale line down here. So if I sell 0 items, I'm still going to have a cost of $1 million because of those fixed costs that I have in this whatever example it is. So I'm going to have a loss of $1 million. If I sell 500 items, I'm going to have sales of close to $1 million, but I'm going to have cost of about $1.5 million, so I'm going to have a little bit of a loss. But if I sell 1,000 units or thereabouts, I'm going to have about cost of $2 million and a sales of about $2 million. And then, as you can see, the costs continually kind of keep on a very even pace. I'm covering more fixed costs per item, while my variable cost still does go up the same amount. But the key is you're covering your fixed costs. Okay, the last thing is margin of safety. Margin of safety basically says, how much of a cushion gap do I have from where I'm at right now to where the absolute bottom I want to be, my break even? How much in sales dollars do I have to fluctuate? If I was doing my previous example, where I'm at with 500,000 students, it was 596 students. If I had 596 students, so that brought me sales of 894 minus the 241.5 in break-even point. So this was my actual where I want to be minus my break-even point where I have to absolutely be. I have a cushion here of 652,500. That's our margin of safety. And then the margin of safety ratio, simply take what the margin of safety is and divide it by your sales of where you're at or expect to be, 73%. And we'll see how this kind of comes into play in a little bit of our work. The last thing that I want to draw your attention to, this chapter, for whatever reason, doesn't have a real good income statement for you to be able to follow. But if you just go into the couple opening pages of the next chapter we kind of still talk about the same stuff. And so if you go to page 924 in chapter 20 of the combined book, there is a nice example of an income statement that we're going to follow to do the Wiley Plus problem. Okay, that is it for this chapter 19 week of new stuff. We're going to our next video here will be looking at the Wiley Plus. If you do like this video, please comment down below in the YouTube. That would be helpful. That helps me know if these are actually working out as I had planned.